The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. On today's episode, we're going to be continuing our entity series and discussing C corporations. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you, Chandler. Thanks for that. You always do the best intros.
Top tier.
So thank you for that. Today we're kind of ending our, what we used to call summer series, and now it's just our entity series.
It's November when we're recording this.
Yeah, it's not like we recorded this during the summer. Yeah, it's November. But so today we're going to be talking about C Corps, and probably one of the most overlooked maybe for small businesses. You don't hear about it that much when you're online. I don't know, maybe you are, and maybe the things that I'm looking at are different, but from what I understand, most people aren't looking at C Corps for starting a business.
Yeah, for lots of reasons.
Yeah, which we'll go into today.
Yeah, many good reasons. But maybe there are some good reasons why you should look at it.
Yeah. Good. Yeah, that's a good summary of what we're talking about. The good and the bad reasons.
Just end the episode now.
Yeah, there's good reasons and bad. So kind of like with the other entities, we just went to the IRS website, and they have a very nice, succinct definition of what a C Corp is. So I'm just going to be wording this verbatim from the IRS. So they say, informing a corporation, prospective shareholders exchange money, property, or both to the corporation's capital stock. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions, which we'll talk about that later. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. A corporation conducts business, realizes net income or loss, pays taxes, and distributes profits to shareholders. The profit of a corporation is taxed to the corporation when earned, and then is taxed to the shareholder when distributed as dividends. This creates a double tax, which we will also talk about later. The corporation does not get a tax deduction when it distributes dividends to shareholders. Shareholders cannot deduct any loss of the corporation. So
that last little bit you said there kind of summarizes the big reason as to why a lot of small businesses are not electing to be taxed as a C Corp.
Yeah. So pretty much like the sole prop, partnership, S Corp, we've been talking heavily about how it's a flow-through entity. C Corps are not considered a flow-through entity because of many of these reasons.
Yep.
It is considered in the IRS. In the IRS's eyes, it's a totally separate thing, right? And C Corps file in 1120 by the 15th day of the fourth month after close of the tax year, which is just jargon for April 15th, similar to individuals.
Yep.
If you have a fiscal year end, it's going to be differently, but for most people, they just do the calendar year end.
Yep.
And what's also nice about C Corps is you can have unlimited shareholders. I mean, when you think of C Corps,
well, that's like your big, New York Stock Exchange, stock companies that you say. We're talking Apple, Google, all these things. Those are C Corps, and they've got how many millions of shareholders. If you own a piece of stock, you are an owner in that company of that C Corp.
You can own fractions of stock of
That's right.
these types of corporations sometimes.
Yeah, so you're a fractional owner there as well. So, yeah, so when you think of C Corp, a lot of the times you think of those big companies, but, you might also maybe curtail your thoughts or change your thoughts to be thinking, how could something like that benefit me? Right?
Yeah. So let's go down into, we'll kind of discuss the taxation of the income in a C Corp. So like Spencer mentioned, so the filing day is the same. It's April 15th, just like it is for an individual. Mm-hmm. So it's kind of taxed like an individual. except everything just gets lumped into one net income number and gets taxed at 21%. So your gross income, sales, interest, capital gains or losses or royalties, that's your gross income. Then you've got deductions of your ordinary and necessary business expenses, potentially charitable contributions. Now, charitable contributions do have a limitation that applies to C Corps. And the max deduction you can take on your charitable contribution is up to 10% of your taxable income before the charitable contribution. So you take your net income, take your deductions, and then you get to your taxable income number. So on an individual, we say, your capital gains, those go to this schedule, and they're taxed this way.
Mm-hmm.
And your wages, those are taxed this way, right? And then, by the way, your other interest and dividends, those might get lumped together and taxed this way.
Or they could not be.
Or they could be excluded. Yeah, who knows? But instead, on the C Corp, it's all just lumped together and taxed at a flat 21% rate.
Yeah.
Now, so moving on from there, so one interesting and unique deduction that you can get on a C Corp is the dividends received deduction.
And some people call it DRD.
Yep, the DRD.
Yeah, if you're on the streets.
If you're inside.
You got that DRD. Yeah.
Yeah. And the purpose of this is to avoid a terrible, awful situation of triple taxation.
Yeah.
That's really what it comes down to. So if your C Corp owns stock in another C Corp, so and you get a dividend, so you're getting income from a company that's already paid tax on it,
mm-hmm.
and so they're going to give you a deduction for a piece of that dividend. And so there are rules that go into what qualifies for a DRD and how much you can apply. But basically, I'll summarize it and just say a C Corp can get the DRD for dividends from a domestic corporation, and it rates like this. So if you own 0 to 20% of that corporation, you get a 50% deduction. If you own 20 to less than 80%, 65% deduction. And if you own 80% or more of the other corporation and get a dividend, you can deduct 100%.
Yeah, and that's when you say dividends received deduction, you're not like, 100% of my income is not taxable. No, it's just on the dividend income.
Dividend portion from that other C Corp.
Yeah, so if my C Corp was 100% owner of, dog grooming, C Corp or whatever, if it's 100% owner and it gets a $500 dividend, then I don't have to take that dividend as income, essentially. It shows up in my gross income section of $500, but then it gets backed out at the bottom of the page.
Yes.
Under dividends received deduction.
Yep.
I believe I said $500. So.
Yeah. Yep. That's that, and that's something that's unique only to C Corps. So, lastly, the taxation or the tax effect of a net operating loss is unique to C Corps. So, a C Corp, if you have a net operating loss, you cannot carry it back, but you carry it forward indefinitely, and you can use that NOL to offset up to 80% of the taxable income in any given future year.
Yeah.
So if you have an NOL of $100,000, and then in the next year you make $100,000, you can take an NOL to reduce that taxable income down to $20,000, 80%. You'll have an additional $20,000 carried forward to offset future income.
Yeah. And I will say this specific rule for NOLs has changed quite a bit throughout the years.
Yes.
So depending on when your NOL is actually incurred, like when the loss is actually incurred, that NOL specifically that Derek just said is for NOLs that are being incurred like currently.
Yes, that's under the current tax law. But if we go back to the COVID years, there were special circumstances that allowed us to carry losses back in order to get refunds. So if you haven't filed a tax return for, now I can't remember if it's 2020 or 2021 tax returns or both, but regardless, you could carry losses back and you can go and get refunds for prior year tax. But yeah, you're right. The laws around NOLs do change, have changed.
So it's just something to think about.
Might change again in the future.
Yeah, it might change in the future. So, but currently, that's just where we're at with the losses that are being incurred currently.
I will say, so I said all the income is treated the same. More or less, that's true in a C corp. But capital gains, if you actually don't have a capital gain in a year and you have a capital loss, those losses are required to be carried back 3 years, and they offset capital gains from those years. And then anything that goes beyond carrying it back 3 years, it gets carried forward 5 years, and then it's done.
Yeah. So similar to personal taxes, like a 1040, your losses can offset your gains.
Yes.
However, on the 1040, you can also get, if you have excess losses, so if you're at a net loss, you can take up to $3,000, in the year and then carry it.
Yeah, that doesn't exist on a C corp.
Exactly.
You're not getting a special $3,000 deduction. It's only offsetting other capital gains, and you carry it back, carry it forward, and then it's done.
Yep, and when you carry it, it only offsets those years' capital gains as well.
It's not applied against other types of income.
Mm-hmm. So perfect. So we're talking about tax and how that's being affected and calculated on the C corp level. But there is something to notice and to understand. Just because you have stock in a corporation, a C corp, doesn't mean that you're not also going to get taxed. And that's where the double taxation comes into play. So C corp income, it's taxed essentially twice. One at the entity level, the C corp level at that 21%, and then at the owner level when that income is inevitably distributed to you.
Yep.
Normally it's distributed through cash, and it's called a dividend, right? And we kind of talked about dividends a little earlier. Dividends are just C corporations distributing out cash to their shareholders, right?
Yes.
And so on the owner level, so on the 1040 level, the tax rate kind of depends on what kind of shareholder you are. Ordinary dividends, if you get an ordinary dividend, it's taxed at ordinary rates. If you get a qualified dividend, they're taxed at capital gain preferential rates. Those distributions from C corps are normally classified as dividends. There are some cases where it could be a return of basis or what people call return of capital or a long-term capital gain. But normally they're just treated as dividends. And then that dividend income could also be subject to net investment income tax, which we have talked about a little bit already.
Yep.
So you have double taxation as well as possible net investment income tax of a 3.8%. So you have all this income being taxed at 21%, and then your dividends could be taxed, if you're like a middle income taxpayer, you can say. If you have qualified dividends, you're taxed at like 15%.
Yep.
And then if you're subject to net investment income tax, you're adding 3.8% on top of that. So that income, that dollar, that dividend that you received, taxed at 21% already, then it's taxed at 15%, now it's taxed at 3.8%. So
yep.
It can kind of compound. So when you're thinking like as a small business, you're like, oh, I see this 21% figure, and that's like,
that's appealing. That can be relatively low compared to the individual tax rates that go up to 37%, right?
Right. But then you kind of have to think of it like, oh, I have 21% tax on my C corp, which I guess it's not like you're paying it, the corporation is paying it, but it's still money that's being paid, right? And then on your individual side, if it's an ordinary dividend, it's taxed at ordinary dividend rates. And if your ordinary dividend rate, if you're already in that, let's say you're in the 22% or 24,
right. There you go.
You're already above, right, the 21%. And then now if you're subject to net investment income tax, that's another 3.8%. So It's whereas if it was just a flat flow-through entity, maybe you wouldn't have,
Right, it's not going to have to get taxed and then flow through to you and now get taxed.
Yeah.
So, so I'm going to jump ahead on our our planned talking points and bring up the compensation of owners here. I think it flows into this conversation, and so that's potentially one way in which you can get the best of both worlds a little bit. So if you own the C Corp, you can pay yourself a salary, right?
Yeah, shareholders can be employees.
And so that's where, you can say, okay, well, yeah, I'm going to pay myself a salary here for what my service is here in the C Corp. And that's number one, that's going to reduce the taxable income of the C Corp because that's an eligible deduction. And then that money, it's going to flow to me as ordinary income. That's okay, but it's not going to get taxed first at the entity level. So, that's one thing that you can do and make sure that you're paying yourself appropriately, and you can avoid some of that additional tax potentially.
Yeah. Yeah, good thought. And fun fact, publicly traded corporations have a 1 million salary cap for covered employees.
That's really interesting. You hear about, I don't really know the details, but you've heard how, I've heard anyway, how Elon Musk, is getting sued for his compensation package, and part of that has to do with the stock he was granted or whatnot.
Yeah.
Right? But it's kind of wrapped up in that figure there, the $1 million, limitation on a publicly traded company. That's part of, how they're trying to work around that by giving him stock and whatnot. But
yeah,
it's kind of an interesting thing there.
Yeah.
I don't know how it applies to the non-publicly traded corporation, except for I'll note. So every year you probably can't just go ahead and say, okay, how much money has the corporation made? Or I'm going to pay myself a salary to essentially wipe out all the income, right? Because we go back to what's an allowable expense, and it's got to be ordinary and necessary.
Yeah.
Right. And so you could be playing a dangerous game if that's the route you were going to go.
Well, and on C Corps, let me just fact check myself real quick. But there's a spot on when you're filing your return where you post the salaries, right?
Yeah, compensation of officers.
Compensation of officers, right?
Yep.
So
you're reporting it bluntly, yeah. So it's easy for the IRS to review and audit if there ever were to be an issue.
Yeah, I don't know what schedule that is, but maybe Chandler can look it up. But yeah, anyways, so kind of going off of that, so there's that owner level income tax, compensation of owners. Let's say you do have this C Corp and you think it's a big idea, it's a big hit, and you think it's going to go places, right? There's something called Section 1202 or small business stock that gets thrown around, and maybe people know about it, maybe some people don't. And this is one of the best ways to not have to pay tax when you eventually end up selling your stock in the company.
Yeah.
So one of the advantages of a C Corp is that if you want to bring on a ton of investors, it's a great vehicle for that because that's the unlimited shareholder route. And you can incentivize investors by saying, hey, my C Corp stock is qualified small business stock. Now, what the heck does that even mean? It's essentially non-corporate investors. So if your stock qualifies as small business stock, non-corporate investors may exclude 100% of any gain they realize when they sell that qualified small business stock. There's requirements. The stock has to be held for a minimum of 5 years, and the the amount of the gain that is eligible to be excluded is limited to the greater of 10 million or 10 times the taxpayer's basis in the stock. The rules for this have changed a little bit for the 100% exclusion. So August of 1993 to February of 2009, it was 50%. February 2009 to September 2010 is 75%. And then September 2010 to now, it's 100% exclusion. So if you possibly have any qualified small business stock before September 2010, then you would be subject to those other either 50 or 75%, depending on when you received the stock.
Yep.
But this can be really advantageous for people who their strategy for the company is to build it up
and then exit.
Right?
Yeah, so it's a great startup place to be in. And, the key here is it's qualified small business stock. So there are limitations on the number of assets, the amount of assets you can have in order to qualify for this.
And there's even a limitation on how the assets that are in the company are being used.
Yes, basically, it needs to be an operating company.
Yeah,
and it has to be less than 50 million in assets, and so that's where that comes in.
And not all corporations are eligible for this Section 1202. Like S corps are not eligible for Section 1202 small business stock.
Right. It needs to just, and it can't just be an investment. So it's not like we can't say, okay, Spencer, let's form a C corp, and then we're just going to buy we're going to buy a bunch of whatever asset. We'll buy a bunch of stock in a bunch of other companies.
Yeah.
And then we're going to sell that stock, and we're going to then we're going to have all this money in value in this company, and then we're going to sell our shares in this company, and we're going to exclude all of our gain.
Yeah.
it can't be that. It has to be an actual operating company, and but it's a super beneficial part of the tax code, and it's really meant to incentivize investments into small businesses and in creating new ventures.
Mm-hmm.
And that's huge. You can exclude 100% of your gain. 100% of a 10 million gain or more could be excluded potentially.
Yeah.
So that's.
And I would also note as well, and we might talk about this later, if you decide to start maybe with just a partnership, because partnerships are also good investment vehicles as well.
Yes.
If you start with a partnership and then you're like, this partnership's getting pretty big, maybe I should think about, what are my options? Do I keep it as a partnership because because it's getting so big, maybe I want to sell my interest in the partnership? You can convert a partnership to a C corp.
Yep.
And it still can be qualified small business stock.
Yes.
And then whenever you end up deciding to sell what now it's stock in the C corp, you have this Section 1202
that could potentially apply.
Mm-hmm.
Yeah.
So
main thing is, if it's something you think might apply, you got to make sure you go through and check all the boxes and do it right to make sure that you can benefit from this. We didn't touch on all the details here, so make sure you verify and consult somebody and go through everything that you need to make sure that would qualify.
Yeah.
Okay. So kind of to wrap things up here, we'll talk about contribution of assets. And so basically, if you're going to contribute assets to your C corporation, generally, it can be considered a non-taxable event if it meets the requirements of Section 351. So the property is transferred to the corporation directly, solely in exchange for stock, and the transfers have 80% control of the corporation immediately after the exchange. So basically, if you're going to be starting the corporation yourself, right? That's kind of the way to look at it.
Yeah.
If I want to buy in 5% of a corporation and I transfer in some assets, that's not going to be considered a non-taxable event.
Yeah. Yeah, it's pretty similar to an S corp.
Yep, exactly. Yeah, so then like distribution can be considered. We've talked about distribution of assets is going to be, if it's cash, going to be considered dividends, or it might be considered a sale.
Yeah.
And so then there's going to be gain or loss associated with contribution or distribution of assets in these other situations.
Yeah.
It's not quite as easy to do like it is with your flow through entities.
Yeah.
Well, with your partnerships.
Yeah. S corp is like their distributions for an S corp are a little different. Like,
yeah, distribution of like typically you can make essentially tax-free distributions from an S corp pretty easily.
But there's more rules,
especially as long as it's cash. But there are more rules than there are with a partnership.
Yeah, but if it's property, then yeah, we're getting.
Yeah.
It's
anyway,
it's definitely different than a partnership.
Yep.
But yeah, so just to go over kind of the pros and cons, kind of just wrapping up what we've talked about. Pros of a C corporation: there's no restriction on number or types of shareholders, so very good investment vehicle. Has a favorable rate of 21%. If you think, or if you know, like the money in the company is going to pretty much stay in the company, you're not going to do a ton of dividends. It might be really good to, a good option this way because it stays at that favorable 21% rate. And, if you're not thinking of paying out tons of dividends, right?
Sure.
You have the 1202 qualified small business stock exclusion. And we've kind of talked about passive loss rules, but it's generally not subject. C corps aren't.
Yep.
However, we have cons of 2 levels of taxation, possibly even 3, right? The triple taxation with the dividends received from, if you have 3 corporations, you have, and they all
taxed at level 1,
level 1, level 2, and level 3. If you don't have enough ownership, at least a portion of that, right, is going to be taxed.
Yep.
There's potential for, and we didn't talk about this at all just because it's kind of convoluted, but accumulated earnings tax.
Yep.
Which is essentially just if you hold too much money in your company,
and you're not paying it out, there's going to be additional taxes.
Yes. Yeah. So kind of like what I said, if you're going to be spending a lot of money, keeping a lot of money in the company, that favorable tax rate of 21% is good. However, you don't want to keep too much money in the company. You want to be spending it, right? And if you accumulate too much earnings, you could be taxed, right? So, and we don't have enough time to get into that today. There's a potential for a built-in gain tax, specifically with like property and so on. There's taxable conversions to a partnership. So if you start as like a C corp, but then you're like, meh, I really like the flow-through way. Flow-throughs seem more beneficial.
Yeah, your accumulated earnings and profits are going to be still subject to tax potentially at that point.
And just getting assets out of the C corp is going to be taxed, right, if you're converting to a partnership. So there's just things. A C corp, it's more advantageous, in my opinion, I guess, for a general purpose, to start as something else before you decide to become a C corp.
Yeah, this is definitely not the starting point for most small businesses, unless you're in some unique situation where you really know exactly, like you have a really solid idea of what's going to be happening, and you know that it's going to be a large deal, right? If you're like, I don't even know, I can't think of a situation, but typically this is not going to be the starting point for your business entity choice, especially as a starting something from scratch. But you could get there relatively quickly. I mean, if you get onto a good idea and you start doing well, and you're maybe looking to exit or bring on investors, this is a great can be a great vehicle to do so. I'll say here at Larson, we don't do very many small business C corp returns.
Yeah.
It doesn't lend itself really well to the small business, sphere. So.
Yeah. Well, and we didn't even talk about, and we can mention this as another con, there's no QBI. So C corps don't have that, which qualified business income. I should say out my acronyms. Qualified business income, like the 20% deduction of just your general business income you don't get, right? So there's no QBI. But yeah, that's pretty much all the topics that we wanted to talk about today. Some future topic episodes that we have come across while creating this episode: cash versus accrual deep dive. A lot of C corps are under that accrual tax accounting method for tax. There's unit cap rules.
Capitalization of inventory and
yeah, there's accumulated earnings tax, which we barely talked about. We just brought it up a little bit. Distributions of real property, C corp conversions to a partnership. There's more to talk about with Section 1202, like which corporations are not allowed, what are the actual requirements. We kind of talked about those today. There's DRD, so dividend received deduction requirements and limitations. There's personal holding company tax, which we didn't
talk about. Basically, it's why you don't really want to just make your C corp your investment vehicle, right? You don't want to just have your C corp invest into a bunch of other activities, because then all of a sudden you're going to be potentially subjecting yourself to personal holding company tax.
Mm-hmm. And then just kind of talking about distributions in excess of accumulated E&P, which
earnings and profits,
which would cause a return of capital or long-term capital gain or whatever. So, yeah, I think that's everything that we wanted to talk about today about C corps, and that's all of the entities that we kind of wanted to go over as well.
Yep, that's not all the entities that you could be.
Just
we've got plenty more, and there are other weird things. There's like associations. And here at Larson, we do a lot of 1120 PC returns, property casualty insurance companies, and
life insurance returns.
Life insurance
1120L,
return. Exactly. So there are lots of other entities out there. These are kind of the main ones that the majority of people would
have questions about.
Have questions and need to know. So
and be looking.
Most of the ones we just listed are more niche, and you probably know that you're going in that direction from the time that you're starting your business, as opposed to the ones that we've discussed so far.
Yeah. So if we on any of the entity ones, if we talked about something that you've heard that we didn't talk about, or if we talked about something that you want to know more about, feel free to reach out to us at our email. Is that still in the?
Yeah, it's you can always hear the email for our podcast in the outro of every episode. So if you're ever curious,
boost our watch time.
Yeah. Make sure to listen to the end. Listen to the beautiful song as it plays out, and then you can hear me tell you where you can email any episode ideas.
Yeah. And this isn't obviously the last podcast that we're doing. We have more ideas. I have a huge list.
Yeah.
We have a huge list of things that we want to talk about.
Much more to come.
But feel free, if there's something that you want to listen to, reach out to us and we can.
Yeah.
It might already be on our list, or if it's not, we'll put it on. We can put it towards the top so that we can talk about it.
We've got other helpful tools out there as well. Spencer and I both organize a couple of our newsletters here at the firm.
Mm-hmm.
We'll link to those in our show notes. I do the small business newsletter. Spencer does our Larson tax newsletter, and we link to the show there. But we also have other blog posts that we've written, or members of our firm have written, and lots of good information out there.
Yeah.
So.
Yep.
Thanks for listening.
Thanks, everyone.
Thanks, guys. For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.